Welcome to Macro Musings, where each week we pull back the curtain and take a closer look at the most important macroeconomic issues of the past, present, and future. I am your host, David Beckworth, a senior research fellow at the Mercatus Center at George Mason University, and I'm glad you decided to join us. Our guest today is James Clouse. Jim is a fellow at the Anderson Institute for Economics and Finance and a longtime veteran of the Federal Reserve System, including serving as the Deputy Director of the Monetary Affairs Division and the FOMC Secretariat. Jim joins us today to discuss his time at the Fed as well as some of his recent work. Jim, welcome to the show.
Thanks for having me, David.
Well, it's great to have you on. I followed you from a distance, and I was real excited to learn that you would be willing to join us. You have just stepped down from the Federal Reserve. And I have to say, you have an amazing career. 36 years at the Fed, a year at Treasury managing our debt, and 4 years in the Army. You are a true American hero. You know, some American heroes wear camouflage, black jackets, and carry rifles. Others wear suits, run models, and quietly safeguard the stability of our economy. So thank you for your service.
Thank you very much. I appreciate that.
No, it's great to have people like you do what you do. And, you know, it's often easy for people like me and others to criticize the Fed from the outside. But what you really do matters. And it's easy to take it for granted. When everything's going well, you don't appreciate all the hard work that you guys do at the Fed behind the scenes.
Well, you've talked with many Fed people, and of course, there's just hundreds of very dedicated, very smart, professional people all focused on achieving the mission. So it's a very gratifying place to work.
Yeah. Now, before we get into your career, I want to hear the details. And the other thing about your career, 36 years, you've lived through history. You experienced it firsthand. And when I looked through all the things that you've done, I was just blown away. I mean, you probably could write an amazing book. I don't know if it's in your plans, but you should. But with that said, so when you're sitting there on the inside, and you're the Deputy Director of the Monetary Affairs Division, you're a staffer for a long time, you're in the FOMC taking minutes, transcripts, whatever you did there, you heard people like me on the outside and others even more cantankerous than me criticizing. Did you ever feel frustrated? Because in your role, you got to keep your mouth shut. You got to be, you got to play the role, the good civil servant. I mean, do you ever want to say, no, Beckworth, that's wrong? But I mean, does it feel good to be on the outside now, be able to a little more freedom to share your thoughts?
It does feel good to be on the outside and have a little bit more freedom. And you're right, especially on the staff, work very hard and lots of communication within the staff, but not a lot of communication in the broader public. But I didn't feel any particular frustration towards you, David, or toward anybody else. Of course, criticism is part of the game, and in a broader sense, even sometimes it's a little uncomfortable and a little messy. It is important for the broader public to have a sense of what the Federal Reserve is about, and that probably, as we'll discuss later, I think the whole communications push over the last 2 decades has been a big part of that.
All right, well, let's jump into your career. So I mentioned you're the Deputy Director of Monetary Affairs. You also oversaw the FOMC Secretariat. You spent a year at Treasury. So where did we start? When did you first begin at the Fed?
I began at the Fed in July of 1989. I felt very fortunate to be hired at the Fed. As we were chatting earlier, I came out of the Army after serving a military obligation for 4 years. And, that's kind of a little bit of an unusual path into the economics profession. And so I was very pleased to be hired. And I landed in a section that was focused on the money numbers, the monetary aggregates, which at the time, were an important policy guide.
Yeah.
There was a little bit of a dichotomy, or I'm not sure how to frame it, but that differences of views within the board about just how important the money numbers really were. You probably know that people in research and statistics, they rely very heavily on a kind of a Phillips curve type of framework, and the money side was kind of the money and velocity. There used to be a sign when you would walk into the building, and on one side it would say PQ, and that would point to research and statistics, and then MV was pointing to
That's awesome.
Monetary affairs.
Oh, that's fantastic. Now, so you came in right during the time where money began to kind of fall out of favor because this breakdown in the relationship between monetary aggregates and nominal income or the broader economy. And so I would say money still matters, but it's hard to measure it. It's hard to know what money demand is in real time. And every macro model has these unknown latent variables. At Phillips curve, you got to know the output gap. A monetarist needs to know real money demand. You can't observe that either, right? So it's tough. But the central banking has moved on mostly Phillips curves and thinking in terms of neutral equilibrium rates and such. But that's cool that you were there. You got a little taste of that, at least during that period.
Yeah. I think that my impression is that Chairman Greenspan probably had a little bit of the flavor you do, that he still thought in his heart of hearts that money or nominal magnitudes really did matter. But the staff, especially in research statistics, kind of did focus more on the Phillips curve framework. And, the reality is I think you probably know better than almost anybody, it's just very hard to forecast inflation. I mean, there's no model out there that's a slam dunk.
Yeah, that's why I'm a nominal GDP targeting fan, because I know it's hard to use money as a guide, and so get money times velocity, or some would say velocity adjusted money supply, but neither here nor there. So you're working at the Fed. You're there at the tail end of when money was still being used. Do you remember the time where the McCollum rule was discussed? I know the Taylor rule, we'll talk about that in a minute. It became very popular. But the McCollum rule was this rule where you adjust the monetary base according to a nominal GDP rule. And for a while, it had some attention, right?
Yeah, so I have only a vague memory of that. I wasn't so tuned in to – I was very much in the trenches. I was really in the trenches.
Okay.
So I didn't really
at
that time, I wasn't totally aware of all the debates going on in the literature. But I do, since then, of course, have learned a little bit about the McCollum rule. But I think those were starting to filter into the staff consciousness in the early 90s. And you're right that there was some attention paid to it. But even the Taylor rule – it did take a while for it to be fully embraced. I think people like Don Cohn, for example, you probably know well, and others, were onto it from right from the start. But I think that it took a little while to really filter into the staff's way of thinking.
So when did you start seeing it widely discussed, like, say, at FOMC meetings? When did it become important?
Yeah, I'm probably going to get the dates wrong here because I did look this up once, but I believe that the first briefing of the policymakers might have been in the 93, 94-ish time frame. So pretty early on. But again, it was not universally accepted as kind of the way of doing it. And it's still not. Of course, people like to use rules, the standard Taylor rule or other rules as a benchmark, but then all kinds of other considerations fold into their thinking. But it's a very useful benchmark and encompasses some important principles of good monetary policy. So that I kind of like to look at them as a starting point. But I would say over time, the importance of rules became very, very important. But even for many decades, I would say that it was a little bit of an arm's length thing because nobody wanted to feel constrained by a rule either. So it's a very interesting push and pull.
So Taylor had this paper in 93 where he put out his Taylor rule, so it makes sense that you guys would start talking about it about that time. But I went to a Hoover Monetary Policy Conference this year, and John Cochran, Michael Bordeaux, and John Hartley did a paper on the Taylor rule. In fact, it was a 2-day conference. They had a day where it was like dedicated to John Taylor, and the second day was a regular conference. And they went through and they tracked all the citations to the Taylor rule. And you're right, you don't see it like a whole lot in the 90s. This after he first released it, but it really takes off in the early 2000s. You see a lot more benchmarks. So, yeah, it's in terms of a benchmark. We where do we start? We start with the Taylor rule and go forward. So it's interesting to see his legacy, and they mentioned in this paper that the FOMC eventually starts to talk about it a lot. But it took some time, like you said. Now, this all goes on about the same time as we see increasing transparency in the 90s in the Fed. We see minutes for the first time. We see announcements. Talk about that.
Well, that was interesting, too. And again, I was very much in the trenches. But looking back on it now, I am sort of very grateful to have been there at the sort of beginning of the big trend towards transparency. When I first got there, of course, Alan Greenspan was the chair. And, there were all the stories about, not being totally clear on intentionally. But over time, I think the profession moved towards the value of clarity, and this was very much emphasized by Chairman Bernanke, of course. But actually, I think a big impetus for the Federal Reserve was criticism from the outside. There were some issues at the end of the 80s, and I'm going to get some of this information wrong and the dates wrong, but there were some leaks associated with the FOMC that caused a lot of furor, and there was Henry Gonzalez, I don't know if you remember him, but he was the chair of the House Banking Committee at the time, and he was a fierce Fed critic and was really pushing for more transparency from the Federal Reserve and on things related to the discount window and lending operations. And he pushed and pushed and pushed, and eventually the Fed started moving in that direction. And so the first statement, I believe, was issued in 94. It took a while before it sort of evolved into its current form.
Yes.
I think the first statement was issued as it wasn't clear who owned the statement. I think it was very much Alan Greenspan's statement. Wow. And then for a number of years, I think the committee actually only voted on like one or two sentences in the statement, like the balance of risk. But then eventually in the 2000s, they moved towards voting on the whole statement. So, but the whole communications thing has been quite amazing, moving from the traditional world of kind of secrecy, which I think was kind of partly related to political pressures, towards a more open process. And now, of course, press conferences and statements and minutes out in 3 weeks and all these things. So
that is so interesting. So the initial openness where we start to actually know what the federal funds rate target is, we actually have a statement, was probably just Alan Greenspan's, view of how things turned out. And now today, my understanding is that's a very complicated process. In fact, maybe tell us about that. How do you, as a former secretariat, how do you get everyone to agree this represents what we said and did in the meeting?
Well, that is no small task, and there's a small army of staff people involved in producing the statement and in producing the minutes after the meeting is over. And the statement, usually there are initial drafts prepared by the staff.
Okay.
They're carefully reviewed by the chair and some other leadership of the committee. It's then vetted with the committee in advance of the meeting, so they take feedback from other policymakers, and the staff gets. And by the time they see the teal book, the staff document that goes to them with policy options, the statement is more or less locked down. But then they have their discussion at the meeting, and then the minutes get prepared. The minutes, as I learned in my years as secretary, a whole process unto itself. It's kind of stressful, to be honest, because it just has to happen so quickly. The minutes are, the meetings themselves are immediately transcribed. They're recorded.
Yeah.
There's a transcript prepared, and then we've got a small army of people like furiously writing up summaries of the minutes over the space of a few days. And there's a whole process connected with that of review at the staff level, review by the chair, review by the committee members with feedback, and is somewhat can be quite painful at times. Oh, one of the things on the communication that has, I think, been a big change, actually involves a lot, is the preparation for the press conferences. The Chair Powell, to his great credit, he takes those very seriously, and the staff has a very involved process in prepping him for those. Mm-hmm. There's a document that's lovingly called the War and Peace document with literally hundreds of questions from all kinds of different corners of the Federal Reserve on supervision issues, monetary policy, of course, all kinds of political issues or political-related issues that could have come up. And so the whole communications infrastructure has just gotten much, much bigger than it was when I first joined the Fed.
Yeah. You see Chair Powell open that folder, and he doesn't remember. He'll flip to the page, and you'll see.
It's kind of amazing they can do that very quickly. But, one of the things that's really good in the way he handles that is that there is the War and Peace document, but then there's the so-called hot list, which is kind of what people view as the most likely things he'll be asked. And he does a good job of having a few questions that are kind of just intended to be the general framing of things that he can use to answer a variety of questions. Gotcha. So he often kind of starts with that. But there's a process involved there, and he's a very active participant in that process, and it usually turns out quite well.
That's remarkable because there's not much time between the end of the meeting and that press conference, so you guys must be working hard to get the questions to him.
Well, yeah, the process actually starts a couple of weeks before the meeting. So these documents of questions, people start trying to anticipate the questions that could come up with. So while all the other staff work is going on, the preparation of the teal book, preparation of memos, preparation of the statement, there's also the preparation for the press conference, and that's a process unto itself. So a lot of people are involved in that.
So they're doing this ahead of time. They got to have questions for different scenarios, like if we raise rates, if we don't raise rates, or cut rates and don't cut rates. We got to have questions for both scenarios, and that's you got to play it out, huh?
I think that's fair. Of course, usually, to be honest, by the time Usually it's pretty
Okay.
good sense of what the outcome will be, but still, to your point, the questions need to encompass a wide variety of angles that people could have
Right.
on that. So you did this, but why didn't you do that? Or you did this, and why didn't you do more? Or,
Okay,
so
I
a
see what
lot
you're
of things
saying.
like that.
So even like now we're recording this, and next week there's an FOMC meeting, and we all know pretty well what the Fed's likely to do. So it's not too difficult to come up with the scenarios. It's probably harder when there's a crisis, something big, unexpected happens.
Yeah.
Then you're like scrambling to come up with material.
Yeah, that's true. I think when there are crises, it makes it much more challenging. And the statement is so structured and kind of formulaic, it's often difficult to really have kind of an expansive discussion of how something that has just happened is going to affect the outlook, because, of course, nobody really knows at that instant in time. So that's where I think the press conferences are a very helpful addition to the communications toolkit, because you can be more expansive. There's a potential for back and forth, and so but it's a continual challenge.
So my observation from the outside is that it's probably helpful that Chair Powell had been at the Board of Governors already, and so he had a knowledge base built up. So becoming chair, you already know some of the history behind some of these questions, right? As opposed to if you bring someone new from the outside, it's going to be a steep learning curve just to catch up. Now, maybe they already know because they follow, they're a Fed watcher, but it seems like it's nice to have that experience behind you. And then also, I think his personality, I mean, we had a previous guest on the show where we talked about the importance of chairs and leaders of central banks in general across the world, but Fed chair in particular, having the personality, the people skills to connect, not just to be a rote answer, but one where you can connect with people when you talk. And that seems to be one of his strengths.
For sure. Yeah. No, he's a natural in that setting. So we're very fortunate to have him there. He prepares very well, and he's a very active participant. It's not just like the staff handing him a bunch of stuff, but he's kind of editing and giving his views, and he takes that very seriously. But to his great, and your point about connecting with people, he really genuinely wants to hear from the staff as well as his other colleagues on the committee, takes their opinions seriously, tries to incorporate them in his own thinking. So I think that's really a valuable trait for the leader of the organization to have.
Okay, so we were in the 90s. We kind of came to the present. Let's go back to the 90s, some other developments that happened. You were involved with Y2K preparations and the discount window, and then you had 9/11. I mean, there's a lot happening there. So let's stick to Y2K. What was that like?
That was a very interesting experience because, of course, that was a global effort. All the central banks in the world and all kinds of other agencies which were trying to prepare for all the terrible things that were going to happen on that date. And the Fed spent a good year preparing on all kinds of fronts, on supervisory matters, on liquidity matters, operational matters, trying to get currency out in various places where it could be used quickly. The main thing I was involved in at the time were discussions around special liquidity arrangements with the discount window. There was a facility set up for that. All kinds of questions about how the credit unions would be addressed, and there was kind of a special arrangement there. There were various special things done with open market operations too. You may recall there were options sold around on the options on repos, so you could buy an option today to be able to execute a repo with the Fed at a fixed rate, and all of this, and term repos conducted. So all of this was intended to give people comfort that they would have liquidity around this entry date change. At the Fed, there was this hundreds of people involved in this effort, and at the top of the Martin Building, there was a command center. There was constructed. Really? It was with an elevated platform, and it had all the screens, from different parts of the world. It looked like,
that's so interesting.
It was quite amazing. And I was there, around midnight, and, nothing was happening anywhere else in the world. And, it got to midnight, and nothing much was happening in the United States either. And everybody kind of looked at each other and said, oh, well, it didn't turn out to be such a big deal. But, of course, that was partly because of all the preparation that happened beforehand.
Oh, I'm old enough to remember that very vividly. We were really worried things were going to shut down and not work. And so, fortunately, it was nothing, but that's in part because people like you and others prepared for it. Make sure. But that's kind of cool. You need to see a picture of this command center, like terminals and people ready to go, like a war room.
Exactly. That's exactly what it looked like. Yeah.
That's so fascinating.
Had clocks from different parts of the world. You knew what time it was in Japan when the day change happened.
Just think the worst case scenario, like if this did manifest in the way they expected, like Japan shuts down and suddenly there's a liquidity crunch there and runs on dollars overseas, and the euro-dollar market has problems. I mean, it could be a cascading scenario.
No, people definitely scared themselves. I was among those, thinking about all these different scenarios that could happen as lead up to Y2K, but in the end, it proved to be not such a problem. But again, that was because of all the efforts involved.
What about 9/11? What was that like?
Well, 9/11 was such a tragic situation. Chairman Greenspan was in Europe, I believe, and there were not that many other board members around that day. Vice Chair Ferguson was there, and he provided great leadership, and Governor Cohn was there, and he also provided great leadership during that terrible situation. But I actually got into work a little bit late that day, and the first plane had already hit by the time I got in, and then the second plane hit. And, I remember being in the offices of the division director at the time, and there were a lot of discussions going on. And Virgil Mattingly, who was the general counsel of the board at the time, was on one side of the table. And all of a sudden, there was this huge noise and a big billowing black cloud. And Virgil jumped to his feet and was pointing across the river at the Pentagon.
Oh, you could hear it?
Yeah, and it was. And then after that, it was all the rumors about, other planes that are in the air and truck bombs and car bombs and terrorists that will be roaming the streets. And so there was a real panic. Well, I think people understood the situation. It wasn't like people were, panicked and not able to perform. But one of the first situations that came about, of course, was that just operationally it really destroyed a lot of infrastructure around liquidity. So a lot of banks couldn't make their usual transactions that they would normally be able to make. So some banks, when the payment system kind of got disrupted, were left with very large funding positions at the end of the day. So the Federal Reserve provided a lot of liquidity at the end of the day through the discount window. I think that day the discount window had outstanding something like $40 billion, which at the time seemed like just like an astronomical quantity for discount window lending. Later on, of course, during the global financial crisis, it was not seen as quite as large, but at the time it was astonishing. And there was a lot of liquidity provided through open market operations. Folks in New York were all over it as usual. So it was an incredible day, a tragic day, but as usual, people across the Federal Reserve System kind of rose to the occasion and trying to address as best they could. And of course, there was some period thereafter where things were still disrupted, but I would say within a week or two, things are more or less back online.
Okay. So did you have to evacuate the building?
Oh, yeah. Most people were evacuated around, I want to say, 10 or so in the morning. A few people, I was there the whole day because of connections with the discount window.
Yeah.
And so there were a lot of discussions. The home loan banks had some issues that day, or questions about what would need to be done if they needed liquidity. And so there are lots of issues like that. So it was a privilege to be there during that time and trying to help out as best I could along with many, many other people, but obviously very tragic situation.
Yeah. I don't mean to make light of that day, but it's interesting. It took 9/11 for many banks to get past their stigma fear of the discount window. And I know that's been a push at the Fed is try to minimize. You don't want increased moral hazard, but you also want to get it to be more regular part of daily use, right? And
I think that's always been the challenge with the discount window. Of course, when they really, really need it, like in 9/11 or in the global financial crisis, they will come knocking at your door because they literally have no other choice other than to go out of business. But you don't really want things to get to that stage. You'd like to have them feel more comfortable drawing in that liquidity beforehand to avoid exacerbating market upsets of one sort or another. So stigma, I've learned this from colleagues like Mark Carlson and Jonathan Rose and some other historians. You're an expert on these topics too. But, I think stigma around the discount window at the Fed has been around for decades. You can read accounts of people being reluctant to borrow at the discount window in the 20s. And I think the Fed sometimes has exacerbated the problem. In the 50s, there was a tightening in regulations and this criteria that required there to be an appropriate reason to borrow, which then led to questions from discount officers. And sometimes it's been seen as connected with the supervisory side of the Federal Reserve, which is not a good way to encourage people to borrow.
Yeah.
But I also think there's just kind of this inherent structural aspect to the discount window. If it's meant to be not necessarily a lender of last resort, but not a lender of first resort, then there's always going to be a question mark around if somebody who uses it. Did they use it just because they had some operational problem, or did they use it because there was actually some more serious issue? And then if you're a banker, knowing that, you're not necessarily going to want to take the risk that people will conclude if they find out that you might be one of the ones that has a problem. So I think there's just kind of a asymmetric information, market for lemons type of thing there that makes it very difficult to get rid of stigma completely. But nonetheless, it's worth trying. That the Fed, as you know, over the last decade or so, in the last few years, has made some efforts to create a sort of kinder, gentler feel to the discount window. I think that has helped some.
Yeah, Bill Nelson, your former colleague, has been on a few times, and I believe he was telling me in the early 2000s they really pushed hard to make the discount window more user-friendly. It's something you can count towards liquidity requirements and such, but it was a challenge, and then comes up the Great Recession, and that completely this reinforces the worst fears of the discount window. And they did introduce TARP and stuff. But coming to the present, because you just stepped down, there's been a lot of discussion about making the discount window, the collateral you have parked there, count towards, say, some liquidity regulations, maybe your internal liquidity test. Some even suggest a liquidity coverage ratio. Do you see that as being a fruitful endeavor? I mean, it's been a big push, I think, across the Federal Reserve System and other bank regulators as well.
I think there's a couple things going on there, and I'm a little dated in some of this, but one issue is just on purely operational issue, having banks have collateral at the Federal Reserve in the appropriate safekeeping arrangement without any conflicts involved with home loan banks or other potential parties that may have a lien on the collateral. Those kinds of operational issues can come up, and you want that to be kind of settled beforehand so that when a need arises, a bank can come in and borrow. Separate from that, I know Bill is a big proponent of this. There are thoughts about whether the discount window was kind of left out in the cold in effect by the Dodd-Frank requirements that basically requires banks to self-insure against liquidity needs to a large extent possible by holding high-quality liquid assets. And then where does the discount window rank then? The discount window was designed to be something that banks could turn to in the event of a liquidity event. But now a lot of the liquidity regulations really channel the banks more towards self-insurance with these liquid assets. So there's a lot of people have suggested, well, maybe it's not the greatest thing for banks to be forced to hold a lot of low-yielding, low-risk assets, and isn't that what the discount window is for anyway? Wouldn't it be more efficient for banks to just get the collateral in place and be able to count some of that collateral towards your, like an LCR-type requirement?
Yeah.
I don't know. It seems like it's a kind of complicated thing. I think probably if Bill were here, he would be saying, yes, that's exactly what should be done. I do sort of wonder, it does feel like the liquidity regulations are in a way helping some banks to anyway internalize the negative externalities that they may have with the system, the self-insurance and having to pay an implicit premium by holding these lower yielding assets. There is a rationale for that too. Yeah. And I sometimes think that the ex post issue is kind of important too. If you have a bank that's holding lots of reserves, say, and they suffer a run or some liquidity pressures and they have to run down some of their reserves, a bank could survive that. But if they have a discount window loan that's sizable at the end of the day and they can't get out of it, it feels like a different deal. That would probably quickly become known. People make inferences drawn. So I'm not sure from a financial stability perspective that they're actually a one-for-one substitute. Okay. At least that's my thought on it.
Yeah. So that's interesting. And talking about the discount window, there's some interesting history going back to the late 1990s I want to bring up with you. And I've discussed this with Bill as well, but in the late 90s, we're running down the actual debt. We're running budget surpluses, right? And though at the Federal Reserves, there was some growing concern, oh my goodness, what are we going to have on the asset side of our balance sheet, And so you looked, the Federal Reserve looked really hard at this. And one of the things they came up with, well, we need to do more discount window loans. That's an asset, right? We can get more banks engaged. And what I learned from Bill is what later became the term auction facility. Yes. That was an idea that originated during this time. Like, this is something we could do. We could auction off these assets.
You're absolutely right. That was a fascinating episode. There was that period, as you know, in the very late 1990s, early 2000, when there were surpluses. And just as you say, there were projections that would continue. It didn't last very long. But so there was a big stat study commissioned, and they looked at all kinds of various alternative assets other than treasuries. Agency debt would have been one. Of course, at that time, I don't think people were too eager to invest in a lot of agency debt. Chairman Greenspan, in particular, I think, was eager to kind of reduce the moral hazard issues generally associated with the housing agencies. But so this idea of an auction credit facility was one of the things that group studied, and that, just as you say, it did come back later to be a very important thing that was actually implemented during the run. And that was actually implemented early. That was implemented in late 2007, I believe. And there was quite a bit of take-up at it for a while.
Well, which is interesting because it's really just a different form of the discount window.
Yeah.
But it's just like put a new name on it.
It's kind of like rebranding. I think the fact that it was an auction facility kind of had a different feel to it, and it didn't settle right away. There was a couple of days lag between the auction and then when you got the funds. So some people point to that as a kind of a way of separating. Like, I've got to have the funds right away.
Panic.
Yeah, and at one point, I think the minimum bid rate was set so low that you were essentially getting term funding at a very, a pretty attractive rate. So there wasn't a big penalty.
So they made it worth your while.
Yeah, exactly.
Well, it's interesting because this is another thing that Bill has suggested, that to make the discount window more regularly used, they need to bring back TAF or some version of that. Do the collateral thing at the discount window where banks can count that towards some regulations, but also have something like TAF just to make it a normal part of operations. But it's interesting to me, though, that this was motivated by the fact that we were running budget surpluses. So it's definitely were the good old days.
They were.
Now we have the opposite problem. I worry more about things like fiscal dominance on the horizon,
I share your concerns. So.
Not about running budget surpluses. Let's move forward to the global financial crisis. And we just touched on it with this TAF idea and liquidity programs. I mean, the Fed went big. 13.3 was invoked in a way it never has been. I mean, Dodd-Frank made some changes to that ability because there were concerns about how it was used, but we still use it in 2020. So what was it like living through? Tell us, what was it like to live through those moments? Because it wasn't just like overnight. It kind of gradually unfolded over a few years.
It did.
Were there sleepless nights? Were there like, man, are we ever going to get through this kind of moments?
Most definitely. That was just such an astonishing period. And, we're very fortunate that we had people like Chairman Bernanke and Don Cohn and Bill Nelson and other people who were, really smart people that could figure a lot of things out. Bill English, you may have talked with from time to time. And literally hundreds of other people across the system. But just as you say, those pressures started to mount there in 2007. I think that's when the initial breaking of the buck happened. Was it Reserve Fund? In August, I think. And that's when the TAF started. Those liquidity pressures seemed to really become prominent in the year dollar market, and term funding for banks became a really big issue. And so the TAF was implemented quite early and had a lot of take-up. And around the same time, I think the swap lines were put in place with a number of the foreign central banks because the global dollar funding pressures were getting hit really hard. And then right away, and I was amazed by this because usually at the Federal Reserve, new developments, new facilities, you have somebody has an idea, gets shot down 4 times, then maybe if there's something, and then you'll study it for 5 years, and then maybe it'll be implemented. But, wow. After that, you were just on a totally different timeline. The PDCF and TSLF were put in place with light speed in early 2008. And then Bear Stearns happened, and that seemed like this momentous thing, and it was. That was the first use of 13.3 in a really long time. There was a very brief period, I think it was in April, when it seemed like things might be kind of getting better, but then it just immediately went south again. By this summer, Fannie Mae and Freddie Mac were in trouble, and Citibank was teetering, and later on it was AIG, and it was just huge. One thing after another. Then Lehman happened, and everything just shut down. And it just felt like, I don't know if you remember that. Well, you may not have been here, but there was a period a few years ago when there was an earthquake in the Washington, D.C. area, which I had never experienced before. And I was sitting in the board building thinking, what the heck is going on? I've never experienced it. And it felt like that. There's all this fog of war going on, too. It's like, what is going on, and how can you possibly address it all? But the policymakers, with great leadership from Chair Bernanke and the staff, really just legions of staff across the board and New York and across the system, really worked incredibly hard to try to make all those facilities come together. And there are better historians than me, but I sort of feel like the stress test there in 2009 kind of were a turning point. There was still a lot of bad stuff going on, but I feel like things started to get gradually, slowly better after that when they got a little bit more confidence around the banks. The TARP injections of capital happened. And so once they kind of got the banking system not stabilized but on a better footing, it seemed like things were on a better track.
Well, I think this is where it's important to do the right counterfactual. What could have been far worse, right? I mean, if there hadn't been these interventions. So it's easy to criticize from the outside. There's a lot of criticisms the Fed received at this time. So not to say we would have gone all the way to the Great Depression, but I mean the fact that it was possible, right? This financial system was crashing. Now let me throw another counterfactual out there to you, and if you want to pass on, I'm totally fine on this. But a critique I have of the Fed at the time, not so much the staff, but this is the FOMC in particular, was that a number of FOMC members were really worried about rising inflation in 2008. And I remember gas prices, commodity prices were driving a lot of this. I remember I was just talking to my colleagues. We paid like $5 a gallon. It was awful. This is back in 2008, right? But there was a lot of concern about inflation during that time. And I believe in the August minutes and definitely in the September FOMC meeting that year. And Bernanke in his book says this is one decision he really regrets, is they didn't cut rates because they were worried about rising inflation. And if you looked at Fed fund futures, they were actually going up the second half of the year when the economy was going down. And to me, that may not be the you can argue how important that was, but to me, that was like you weren't looking through a supply shock. That's a typical, to me, a textbook case of like you have a negative supply shock, inflation goes up, you look through it, and you look to the broader economy. But any thoughts about that observation? Or
yeah, I'm trying to remember the circumstances of all that, and a little bit of that is hazy. I certainly, in retrospect, the committee probably would like to have that one back, to get a mulligan on that decision. But there were some pretty hawkish members of the FOMC at the time. President Lacker and President Plosser and others were quite concerned about the potential for inflation, particularly after the large-scale asset purchases were going in place. I think people were quite concerned that this massive expansion in the monetary base was going to spur lots of inflation. And there was pretty serious arguments, rifts within the committee on just how seriously to take those. So yeah, that might be a point, certainly ex post with the information we have now, where you would say that maybe that concern about inflation was misplaced. But
and that's why I champion nominal GDP targeting. I had to squeeze it in there somehow. Because, if you look at nominal income, now to be clear, GDP comes out with a lag, and the numbers that year were revised dramatically. So in real time, it's not a great guide. But if you look at forecast of nominal income or nominal GDP, at a minimum, cross-check. That's the thing to say, cross-check yourself. I don't know if you remember Evan Koenig. He was from the Dallas Fed. Yeah. He did a great piece. He applied this thinking, because he was a champion nominal GDP targeting, to 21, 22. And he said, is it time to tighten, And he just looked at like a consensus forecast of nominal GDP, and he showed the gap between pre-COVID trend and post was closing. It was going to go above. So he said, yeah, it is time to tighten when the Fed did tighten. So just as a cross-check, all I'm recommending is a cross-check. But let's keep going on, because you have some amazing work you've done even since then. You dealt with a pandemic. Another amazing challenge.
Well, again, along with a gazillion other people at the board and the Federal Reserve, that was just another absolutely astonishing episode. Again, the whole panoply of 13.3 programs and supervisory accommodations and monetary policy actions were in play at the time. I do have this one memory that sticks in my head. It was in March. I can't remember the date, but it was one of the meetings where, and I think it was a board meeting, where the staff brought all these proposals. There must have been 15 things and they were all major. And Chair Powell was at the end of the table and just calmly and approved every single one of them. He had all guns firing at that point. And, he was right. I mean, there's a lot of criticism now about the inflationary episode and everything. But at that time, we had no idea that was going to be the case. And, you're looking at that point and seeing the unemployment rate going up to whatever it went up to, well above 10%, and not knowing how things were going to turn out. If somebody told you you could get out of this, but you might have to put up with a couple years of inflation, you'd probably take that.
Yeah, a lot of uncertainty for sure.
Yeah.
Vaccines weren't out also at the time.
Exactly.
I mean, there's a lot of things we did not know.
Yeah.
And we come out of a zero lower bound world right behind us, the previous decade. So it's like, are we going to be stuck in this? I mean.
Yep. Or was all that was going on. But I think it was the Federal Reserve really stepped up to that challenge in a major way. And the Congress came through too big time. I mean, you can argue about the wisdom of some of the actions that were taken, but the strong fiscal stimulus at that time, I think, was helpful in a way that, you kind of wish had been there in 2008, 2009, too. I think that probably would have quickened the recovery to some extent.
Well, I'm glad you bring that up because I've come to a place where I'm less critical of macroeconomic policy during that period because, one, of uncertainty you mentioned. I think that's huge. I think it's easy to be a Monday morning quarterback. But two, I view it as a war effort. And I got this from George Hall. He has a paper with Tom Sargent. He has several papers. And they compare World War I, World War II, the pandemic. And basically, it's like a world of I'll say fiscal dominance, but basically you got to throw everything at it. Fiscal policy comes swinging, monetary policy comes swinging. You got to throw everything at it. And when you have these emergencies like this, you kind of break the rules. Like you don't, in my view, you don't want to look at a Taylor rule in the midst of a pandemic. That's
for sure.
Now, you want to return to it, and I think it's good to go back and say, okay, why did we break the rule? Why? Yeah. I mean, it's good to assess. Even the gold standard, they occasionally went off the gold. Civil War, you went off the gold standard, slowly worked way back. Yeah. So I think it's important to kind of step back and say, okay, this was a true national, global emergency, and I guarantee if we have World War in the future, we will throw everything at it again. So now with that said, that what makes it difficult is it did add a lot of debt, and we're on now in peacetime, full employment, and we're still running up a lot of debt, and that's makes it tricky. But I do look back with that period with grace towards policymakers because it was uncertain and we're fighting effectively a big war.
Absolutely. I completely agree with your assessment. And these, just as you say, the uncertainty and the risks at that time were huge, and they just mattered a lot to the actions that the policymakers were taking. And I think the lessons from both 2008 and 2020 are, when you have an emergency like that, you need to kind of go big. And I guess, they didn't really go big in 1932, and there was a lot of big problems. I personally think that that 2008 could have been, right up there with the Great Depression had there not been a strong Federal Reserve reaction, at least some reaction from fiscal policy as well, because it sure felt like that. I actually remember talking with my mother at the time, and she was talking about she made some comment about, that little thing we had in 2008, because, of course, she grew up in the Depression. And,
but small by comparison.
And I said, but for for actions that were not taken.
But you mentioned that 2008, 2009 could have been like 2021. We could have had a quick bounce back, a V recovery. We didn't. We had this, I guess, L-shaped slow, permanently below the previous trend path. And maybe it was some form of hysteresis. I don't know, but something. There's permanent scarring. Yeah. And I don't want to beat this horse too much, but if you look at what happened to nominal income, it quickly popped back. Whether from fiscal policy, monetary policy in 2020, it did not. And I think we live in a world of nominal debt contracts. I mean, why didn't we have a major financial crisis in 2020, 2021? There were a lot of things that were done. I mean, there were mortgage modifications, but I think one big contributing factor was nominal incomes were stabilized.
Yeah.
I think you can say we went too far, but that's where the uncertainty comes in. But that to me is the positive lesson learned. If you can quickly restore and maintain nominal incomes on a stable growth path, a lot of the periphery stuff takes care of itself.
Yeah, and I think having a strong fiscal response was very important there, and that certainly supported the nominal incomes. I think the fact that the banking sector was strong and able to withstand pretty good shock at that time helped a lot too. Had the fiscal response not been there and the economy tanked and then there were loan losses and then the banking system goes down, you could imagine some far worse scenarios. So I think supporting nominal incomes but also supporting the inherent strength of the economy and cutting off the feedback effects on the banking system were important.
Maybe a way to kind of summarize this whole discussion here on 2020 is do the right counterfactual. Could you really have threaded the needle better? I mean, I hope so, but I'm not sure that we could have. I think the option would have been what we had versus something far worse. I think realistically, like if they'd been conservative and modest, it wouldn't have been like halfway between. It would have been like a collapse like 2008.
Yeah. I think that's a good way of summarizing it. I mean, when there's a crisis, you just have to respond. And fortunately, we had policymakers in place at the time that understood that principle and executed on it.
Yeah.
And it was really required a change in mindset, because, again, the Federal Reserve typically is a very analytical, fairly slow-moving agency. But when those things happened, to its great credit, it did move quickly.
So, Jim, we've been talking about your amazing career, and I look forward to your autobiography when it comes out one day. And we'll have you back on for that. So I've planted the seed for the future book here. You've had some really neat stuff that you're doing at the Anderson Institute, and I want to touch first on a note that you did in response to Ted Cruz's call for ending interest on reserves. And I think his efforts were well-intended. I mean, he's looking at all the deficits, fiscal pressures. But at the end of the day, he missed something important, didn't he?
Yeah, he sure did. And you recognize this, and Bill Dudley recognized this, and other people immediately kind of noted the issue. But under the Federal Reserve's current operating procedures, the interest on reserves is the key tool that allows the Federal Reserve to control the level of short-term interest rates. And so if you eliminate interest on reserves, you've basically totally blown up the current operating procedures. So there are other ways the Federal Reserve could operate, but to get there, you would have to shrink the size of the balance sheet a lot. And so in the end, what I tried to do in that note was just make the same point you made in, I think, one of your columns, and other people made too, is that the Federal Reserve would have to totally restructure its balance sheet, reduce it drastically in size. And the only thing that would really happen in the end is that the private sector would end up holding a lot more Treasury securities on which the Treasury is paying interest, and the banking system would have fewer reserves, but there wouldn't be any real net benefit for the Treasury stemming from that. And that leaves out the other very important just sort of practical issue is if you actually required the Federal Reserve to do something like that quickly, you have to sell a lot of Treasury securities.
Yeah.
And in doing so, you would probably force the Federal Reserve to sustain some losses, and that does hit remittances to the Treasury, and so that's kind of a double whammy. So very simple accounting points, but it does point out kind of how slippery some of these issues are around the implementation of monetary policy.
Yeah, so bottom line is there wouldn't be all this net savings that they were hoped for. I mean, Senator Ted Cruz, again, I think is coming from the right place, right intention. He envisioned, I think, $1 trillion over 10 years. And as you mentioned, the government would still be paying interest one way or the other. Yeah. So it's it looks like we're paying all this money to banks. But what's the alternative, as you noted, is that banks, if they're not holding reserves, they'll be holding Treasury bills and Treasury notes. And guess what? The federal government's got to pay that too.
Exactly, yeah.
And so the only thing I thought about, and I think you mentioned this too, the only really meaningful point I think you can make is to the extent interest on reserves is higher than Treasury bill rates. And I did a little math calculation, and it still isn't that much. It's something, but it's not anything near $1 trillion. Now, let me step back and ask another point related to this. So there aren't going to be the net savings because one way or the other, the government's got to pay interest to the banks or to some part of the private sector. The other thing, though, is this, and I'm sympathetic to Bill Nelson's arguments. In fact, I've become a fan of demand-driven ceiling systems like the Europeans are doing. But put that to the side. It is the case, at least it seems to me, that the floor system on average generates a lot more net income from the Fed than some other system does. So yes, there's losses now, and depending on who you ask, how long it will take. But if I had run a scarce reserve system, a corridor system, say since 2000, somehow we were able to do that despite all the things we're doing, and I just compared net income over this whole period, added it up, I'm way ahead of any losses we're experiencing now and probably will until. Is that a fair assessment?
I think so, yeah. I mean, if you calculate all the remittances that the Federal Reserve has had over the last 15 years, I think they're well over $1 trillion. So that's, that's a chunk of change. And just as you say, if the Federal Reserve has a very large balance sheet, it will be paying a lot of interest on those reserve liabilities, but it's also earning a lot of interest on the corresponding assets. So a large balance sheet, assuming there's some positive spread between the rate of return the Fed is earning on its assets and its sort of net funding costs, is likely to mean more remittances, more Fed Reserve remittances
so
to the Treasury.
So I think you got to look just at the past as well as the future. If you're going to make a decision on operating systems, you should at least acknowledge this point. So I think that's fair to say. There might be more variance. I mean, if you have, whenever you get to the zero lower bound and then rates, you don't get that positive spread. I think that's a fair point too. There might be more variance. Maybe a corridor system is more predictable but lower net income. So I completely concede this point that the floor system, ample reserve system is definitely going to generate more net income over the long run. Here would be my critique, independent of my preference for something different, is does that not make the Fed effectively a large fixed income hedge fund? I mean, it's doing a wonderful thing in terms of making money, right? But do you see that as part of the Fed's mandate? I mean,
well. Of course, they're not thinking about it in terms of acting like a hedge fund. They're certainly not day trading.
Sure.
They're just buying securities and holding them until they mature. So it's a pretty boring hedge fund. And they're doing it to implement monetary policy effectively. And, for all its – for some, it does have some issues, and you've pointed to some of them, but the ample reserve system does result in excellent interest rate control across a wide variety of environments, even when the balance sheet is very large and when the Federal Reserve is conducting large-scale asset purchases. You can operate that system, and it's incredibly simple, both for the Federal Reserve and for the banks. I don't know if you had the joy of dealing with all the details associated with reserve requirements and the prior regime, but it's mind-bogglingly complicated. And there used to be this thing called the Reserve Maintenance Manual. It's like 300 pages long with all the various details that are involved.
Because banks would find ways around those rules, right?
All that,
sweep accounts.
Yep, all that. And there are all kinds of adjustments and merger things and all kinds of complications. So the current system is very effective, very simple, and I think they feel like it has been a great addition. I think one challenge is that, at least to my way of thinking, I'm just continue to be astonished by how large the quantity of reserves needs to be to get you to the floor. I would have never have guessed that. I mean, I probably shouldn't admit this, but in the mid-2000s, we did estimates like that, like how many reserves would you need to really drive you down to a remuneration rate on reserves, and $50 billion or $100 million or some pretty small number. But now you have this massive quantity of reserves. And even with that, you can still, if you run regressions, you can see some correlation in interest rates between changes in quantity of reserves and short-term rates. And so where the heck is that coming from? And I think it's still a little bit of a mystery. But there have been these various papers that I know you're well acquainted with, but talking about kind of a ratcheting up effect in the demand for reserves. And I think that probably is part of it. Yeah.
I've had on the show several times Sam Schulhofer-Wall. He's really good on this. And, I've talked to him about what the Europeans are doing at Bank of England, the RBA. They're moving to a demand-driven, what I'd call ceiling system. They're going to rely more on the upper part, the lending facilities. And, of course, we got a lot of challenges in the U.S. to deal with if we ever went that direction. But he made this great point. So what they're doing is, they're moving up, and the ceiling might be the benchmark rate to set monetary policy, but the spread is so small. It's not like a big it's so small that you're still pretty close to the that floor, the deposit rate at the Fed. So in his view, it's really not that, what they're doing is not that different. But I do like the idea of having banks demand-driven amount for reserves. And that's another long conversation. Maybe we'll have you back on sometime. I do want to go to one other item that you did research on, and it's related to this. And it's good pushback against my stablecoin enthusiasm, okay?
Oh.
My stablecoin enthusiasm has been about, it's going to increase demand for dollars and dollar dominance is strengthened. It's one thing Trump is doing right for dollar dominance. But you raised a great point I had not thought about, and that is it could dramatically reduce the demand for currency. Now, it may increase demand for reserves depending on what these stablecoins do, what they back their stablecoins with. But if in fact it's all reserves, well, guess what? Reserves are costly for the Fed, right? And they have to pay interest. Now, maybe there'd be some rules changes for stablecoins wouldn't earn interest. I don't know. But as it currently stands, currency, there's no payments. There's zero on it, right? And you're going to lose that golden goose there.
Yeah, I mean, that is kind of the buffer for Federal Reserve income. You've got this perfect liability that pays no interest, and you get to hold interest-earning assets against it. And it's good for the United States, too. I mean, it's a costless thing to produce, and it generates income for the – so, in effect, I mean, if it were the case that stable coins really started to eat into what is the current demand for paper currency, the U.S. Treasury would be kind of losing on that deal. You'd be replacing senior-age income they're currently getting from the Federal Reserve with nothing. I mean, the senior age income would be going to the stablecoin issuers because they get to issue these, zero interest earning liabilities and hold the interest earning assets instead. So it's interesting. I'm sure are acquainted with the history much better than I, but this idea of who gets to issue the thing that's the medium of exchange. Is it narrow banks or is it free banks? Is it national banks? And so now we seem to be landing on at least one corner of it where a type of medium exchange is issued by a new type of non-bank entity, subject to some requirements.
Well, I think the horse is out of the barn. I think stablecoins are happening. They're going to continue to happen. The Genius Act, makes it even more official. So these things are going to happen. It'll be interesting to see how does it affect the demand for currency because overseas that's been a big thing, right?
It's a big deal.
Yeah.
I mean, I don't really know that much about stable coins, but I would think if you were a stable coin issuer and you looked over at the Federal Reserve and saw they've got this a whole bunch of currency outstanding, you might want to try to think of things that would market it to people who are holding currency instead. So.
Well, maybe there will be people who still want to hold physical currency for privacy reasons because even though stablecoin is on the blockchain, and you can't see a name, but there is decreased privacy relative to physical currency. So maybe there'll be some of that, but maybe not. But to me, I do see that the appeal of stable coins. I mean, peer-to-peer transactions overseas, not constrained by some bad government.
In a way, the threat to U.S. currency might be almost broader than stable coins. I mean, just the whole evolution in the payment system that allows payments and Venmo and all kinds of these apps. Why do we need to be carrying around a lot of physical paper currency? I thought the little bit I learned in that note was just looking at the experience in Sweden and Norway where they've mostly gone cashless and thinking about what that would imply if things actually work that way here. It does seem like the demand for currency is pretty well entrenched right now, but on the other hand, a lot of other things seem like they're kind of entrenched, and then they weren't.
Well, it got me thinking, and I don't know I have the answer to it, and I'm not asking you to have the answer right now to it either, but what would this imply about the Fed's operating system? And what could it actually do if in fact, currency in the limit goes to zero because of stable coins? And this would be way out there, but let's say it does for the sake of argument. Then the only other part of the monetary base left is bank reserves, deposits at the Fed. And in order to have a profitable central bank, it seems like you would have to I'm not sure what it would imply, but it might get costly for the Fed.
I think you'd certainly – you're raising a great point. I think in that kind of world, I think the ample reserves regime would still work the way it does now.
Yeah, that's what I was thinking.
But to your point, I think it would be the case that the Fed would run more frequently into situations where it has a deferred asset, where you have negative net income for a period, would probably have to be more careful about what it invests in to make sure that it's, or hopefully to invest in things that are longer term and likely to earn a positive spread relative to the interest rate on reserves. But it would be a bit of a different world.
Well, on one hand, I could see it as an argument to keep like an ample reserve system, but because you'd have this variance and sometimes you'd have losses, it might be an argument to shrink the balance sheet. Like you're going to have losses maybe no matter what with stable coins. So minimize it by holding the quantity of reserves less. But I don't know. I haven't thought through all of that. But you definitely sparked some new ideas here.
It would be great if there was a way for the Federal Reserve to implement monetary policy effectively with a smaller balance sheet. I do feel like the size of the balance sheet and whether it's well informed or not. I mean, it does attract a lot of negative attention that I think is not helpful to the broader goals of maximum employment and stable prices. So
for sure. And I think it opens up the Fed to wanting to be manipulated by politicians. Oh, you're telling me the size of the Fed's balance sheet is independent of the stance of monetary policy now?
Yeah.
Why don't we, do things with that?
Yeah,
that's the danger I see more than anything. So, well, with that, our time is up. It's been a fantastic conversation, Jim. Thank you so much. Our guest today has been Jim Clouse.
Thanks so much for having me today, David.
It's been great. Thank you.
I enjoyed it very much.
Macro Musings is produced by the Mercatus Center at George Mason University. Dive deeper into our research at mercatus.org/monetary policy. You can subscribe to the show on Apple Podcasts, Spotify, or your favorite podcast app. If you like this podcast, please consider giving us a rating and leaving a review. This helps other thoughtful people like you find the show. Find me on Twitter at David Beckworth and follow the show at macro_musings.